So welcome to this week's webinar for the Freedom Education Self-Directed Investing course. The agenda is we're going to go through the mistakes of intermediate investors, review the 3 trades that you've hopefully put on or at least almost put on in the last week, a brief general Q&A on questions that have come up in the week about how to set alarms in ShareScope or SharePad and how to put the trailing stop loss in interactive brokers. I'm going to show you briefly some real trades on my IB account, briefly show you a couple of commodities that are trending up, and then just, if we have time, just talk briefly about the news this week and whether it's worth looking at the news and what relevance it might have to what we're doing and whether we need to follow the news or not. Okay, so let's do the mistakes of intermediate investors. So just as a reminder, this is our pyramid, success pyramid. So a lot of the mistakes are to do with the base of the pyramid around investing psychology. You can put them into whichever books you want after we've gone through them. So this is 8 mistakes intermediate investors make. We covered the 12 most common mistakes for beginner investors on the course, which will also have a separate e-learning for in the near future. So here's 8 additional mistakes that people tend to make even after they've started trading and done hopefully not too many basics. So we have a hand up from Denise. Any questions now?
Oh, no questions, sorry, I'm listening.
No questions, good. Okay, cool. So one of the intermediate investor mistakes is a fairly basic one, actually, is not looking at the bigger picture. So people will get very focused on just one share, and they're not going to be looking at the bigger time frame on the chart. They're not reminding themselves to do the check of the global indices, the S&P 500, the NASDAQ 100, the Dow Jones, maybe the FTSE 100. And they're not looking at the sectors. So is the sector going up or down? And if there's anything to do in the stock, if people are looking at stocks, some stocks obviously are linked to some commodities. So if you're going to be buying a copper miner, like I did last week, then do you think it might be relevant to have a look at the chart for copper itself? Obviously, yes. So all of these are fairly basic things that you guys know, but amazingly enough, a lot of intermediate investors, they get a little bit sucked into an article all just about one share or why you should buy this, or Telegraph says buy that, or news article on Bloomberg says buy this, but they're not stepping back and looking at the bigger picture. So that's a fairly easy one to remind yourself. Here's a simple example about the bigger picture, which I'm sure you know, but it's often useful just to reinforce some of the things that you learned maybe a month ago. So here's an S&P, daily bars, 6-month view. What is the trend? What would you say the trend is here?
Going down.
Sorry, I've muted Denise. Let me unmute Denise. So
going down in the last.
Yeah,
okay.
going down.
Say the trend is down.
Or basically average E to down, because it's 6 months is January to June, isn't it? So just downwards, even though it looks like it's going up.
Yeah, Denise, any comments on what would you say if I said what's the trend here? What would you say?
I would, well, because we're always talking about, overall like 6 months, but also we're talking about the recent 1 month or 3 weeks. Always the recent is down, isn't it? So even it's the previous 5 months is up, but there's a warning sign is going down, so it's not the thing we need to look at.
Yeah, that's a good comment. So what you might say from this, what I would say is, one of the things I learned from a book by Jody Napoli, which sounds obvious but people don't do it, they just say the trend is this or that without qualifying what time frame they're talking about. Now, if you say the trend is up or down, it's actually pretty meaningless unless you say over what time frame. Are you talking 5 years, 6 months, 3 weeks, or the next 30 minutes, or the last 30 minutes? Obviously, you haven't got a trend in the next 30 minutes, so it's going to be the last 30 minutes. So you must, whenever you say what the trend is, you always need to combine it with qualifying what time frame. So in this case, the 6-month trend was up, and now the short-term trend is down over the last 2 months. That would be a more sensible thing. Especially as if I go to the next chart, if I ask the same question here, now that I've zoomed up on a 3-year view, what's the trend?
Up.
The trend is up. Again, you should qualify. Say, well, the yearly trend in the 3-year yearly trend is up. But now that you've zoomed out, you can see that this last little bit up here, let me put the pen on. So here, as we just said, the 6-month trend is up. Sorry, we were on this one. The 6-month trend is up, and the 1-month trend is down, or the 6 weeks down. Now on this one, we have a 3-year trend is up, and you can see that you don't really even notice that much is going. This little last down move doesn't really notice very much on this chart, does it? Because it's just bouncing in between this uptrending channel.
Very similar.
So the important thing to point out is look at the bigger view and make sure you always quote the time frame. Okay, mistake number 2. Have either of you heard of the phrase averaging down?
No.
Yes.
Averaging down is the process of adding to a position that you've already bought some shares or commodities for that matter at a lower price than you originally bought them. So the idea is that it brings the average price per share or unit of investment you've paid for all of your shares down. So the thinking is, to the people who suggest this method, is if you want to be buying, let's say, Weir Group, which is one of our good companies, you want to maybe not buy £1,000 all at once. You might want to buy £250 this week at, let me see, Weir Group's currently at £20.50. £250 worth in 2 weeks' time when it happened, maybe trading down at £19. £250 in a month when it might be at £19.95, and £250 in 2 months when it's at 18 or whatever. So obviously the second, third, and fourth purchases was at a slightly lower price. So therefore the average price for your, supposing it's your £1,000 worth of shares, or maybe supposing it's 40 shares, you bought 10 shares, another 10, and another 10, and another 10. Your average price for those 10 shares might be £19.10 or something. And the idea is, oh well, instead of paying the $20.50, you've got the average price, inverted commas, cheaper. So let me see if you can guess what my opinion is of this type of strategy, because this is often included in textbooks on investing as a recommended way of going into a share. So how does that, what's your personal view of that based on what you've learned on the Freedom Investing KISS strategy?
Can you call?
I would say it's against this strategy.
Yeah, it doesn't make sense, does it? Because you're buying, you wouldn't be buying because the chart is not going up.
Fine. Okay.
I can't argue with the mathematics. The mathematics is, of course, correct. But why would you be buying? The simple question I would ask anybody: why would you be buying more when the share chart is not going up? Doesn't make sense, in my opinion. You can choose what your opinion is, but my suggestion would be: why would you be doing that? If you're going to buy it and it's going up, then buy all of them at the beginning. The only thing I would say is there's something called scaling in and scaling out, which I think we mentioned a month or so back. If you're not 100% sure that you want to put your whole 10% allocation in, a completely valid method is to put a 5% allocation in, 500 quid worth, when it's just broken out and then you can put another 500 quid once what's called the chart has confirmed the move, as in it's broken up above the breakout point for a few days, and it's going up further, because you now know it wasn't what's called a false breakout, so it didn't just pop above the price and then back down again a couple of days later. So that I would agree with. You can either buy the whole 1,000 quid when it goes above the breakout, because you've got your 3% breakout stop, or your 10% if you want to use the basic 10, or you can just put half the position on, and then a few days later, when it's definitely gone up by another 50p or whatever it is, you can put the second half on, and then leave it as normal. But I personally don't see any point in doing this averaging down at all. So that's my suggestion. So other people will have a different view of this. So I think it's a mistake, personally.
Well,
So unless for short, isn't it? Unless it's for short on purpose.
If you're going short, then yes, I might buy more when it's gone down a bit. Yes, and then I haven't actually heard this phrase, but in effect, it would then be called averaging up. But actually, no, sorry, that's not quite true. If you're going short, then you could buy more on the short. If, in my opinion, I would increase my short position if it's going down. But the idea of averaging down when the share is going up is to buy more when the price is lower than when you first bought it. Because the idea is you think the company's so good that when it's lower, that you buy a bit more because it's, inverted commas, cheaper, which is 100% against what I personally teach. Because if it's going down, you do not buy any more. In fact, you're more likely to get ready to exit at the 10% stop, although you don't need to do anything because it's obviously automatic. Does that make sense? So if you're going short, averaging up would be, if you definitely want to go short, when the price has gone up, which is against you, you go short some more, which again doesn't make sense, because if it's going in the wrong direction, I would be certainly not increasing my position. I would be hoping that, not hoping, you don't hope, of course, we don't use the word hope in investing. I would be expecting that the share would continue to go down because I've chosen a bad company with a downtrending chart. Does that make sense?
Yeah, okay.
Okay, so here's an example. It doesn't actually matter what this stock is, but I think, if I remember rightly, it was Marks and Spencer's. And I read about a guy who was averaging down on Marks and Spencer's. So he bought some Marks and Spencer's here, which is fine, because obviously there's a breakout. Great. If you miss that one, you can get that small one there, or buy above that one, and then you've got 3 chances to buy this share. It's going up pretty steeply, but it's fine. So what happened next? Oh, so they averaged down. They say, oh, so the guy averaging down, he's bought 1,000 shares over here maybe, and now he's buying another 1,000 here because he thinks that the overall trend is up, supposedly, or it's a good company, I don't know what. So he's going to buy some more here. Actually, this is a real story. Just coming back to me now. This is a real story. This is a fund manager. Then what happened to M&S?
Down.
It went down further. And this is the fund manager. Unfortunately, my color on the screen has gone a bit funny. The fund manager is sacked here for buying even more on the way down. So he bought even more here.
Okay.
And the fund manager was sacked. A lot of them don't get sacked for doing this, by the way, but I quite rightly agree that they were sacked. So averaging down.
It should have been shorting. I mean, that was if we were following KISS principles, that was going hyperbolic.
Yeah. It was
whatever.
Parabolic here. It's going a bit parabolic here.
I would have been
maybe I would have shorted it below this level here, maybe. I wouldn't be shorting so early here because the trend is still generally up. So for short candidates, as you know, I want to see a chart that's already been going down for a while.
Okay.
That's what happened next. It went up a little bit, went down. There's another short option if it breaks below there. And in fact, it did. That's zoomed out a bit. It went down further, went down further, went down further. So you could have got short at 325. And
what's the catchphrase for Marks and Spencers? I don't know what they're.
I don't know. Oh, it is Marks and Spencer chart. There we go. These are slides I haven't used for a while. So if you'd gone short at 325, you would have, the price there is about 160. So the price difference is, let's call it 175. So you've got £1.50 price difference. If you went short at 325, you've made about 40% profit in this period here. Obviously, your 10% stop. Remember what we said. You're never gonna get out at the low. So you're always going to get out 10% in the other direction unless you manually close for some other reason. But yeah, in that period of time, you would have made about 30% profit on the short position.
Possibly not, Marcus, because that first spike up went back up 10%.
Yes, you're right. You would have been. Yes, you're right. You would have been taken out here. Yes, you would have been stopped out here.
Or maybe even on that first spike up.
Maybe. Yes, you may.
Mind you, it would have been 10% above that.
You definitely would have made this bit here up to whatever the 10% is here. So if that's at 2, let's say that was at 2. That's about 230.
Yeah.
So you would have been stopped out at whatever 10% above that is. So 23 above. So maybe at 252. So if you sold at 325 down and then back up to 252. So you've still got 75 pence worth of profit here in this bit. So 75 pence worth of shorting profit from an entry at 325 to 252. So 75 or 73 pence or whatever. That's approximately, well, it's about 25% profit, isn't it? Just in what? This is a yearly chart, so that's approximately 6 months. In about a month and a half, you've made 25% profit. Very good trade.
Yeah. Did they have any profit warnings around 97 to 98?
I can't remember.
Be interesting to have a look, wouldn't it? See whether that was basically what we've been talking about this week.
Yeah. Okay, mistake number 3, fear of new highs. A lot of traders and investors have a problem with buying when the chart is at a new high. Because they think, well, why do you think it is? Any of you guys, why do you think some people have an issue at buying at a new high?
Because they're scaredy cats.
Yeah, well, what are they scared of?
Losing money. You're going back down to below what the new high was.
That's part of it. I think that's part of it. I mean, I obviously can't read into their heads, but I'm guessing that that's part of it. But there's actually two other reasons. One's what we mentioned on the screen here. People think it's too expensive. Why do they think it's expensive? Is a share ever cheap or expensive?
No.
In my personal opinion is a share is never cheap or expensive in the simplistic sense, because the share is just the price. The price is just the price. Expensive and cheap are mindsets in your head. The only possible time where I would say a share is cheap or expensive is if you qualify it by saying compared to the net book value of the company. So in some cases, the breakup value of the company is a lot higher than the actual number of shares times the current share price. So the shares times the share price might make the company worth 100 million. But if you bought it and sold all the buildings and the cash in the bank, you might get 150 million. So in that sense, you could argue that the share price is cheap, but it's only cheap compared to the accounting book value. But in itself, is it cheap or expensive? No, it's just the price. So a lot of people have an issue with buying at all-time highs, and they think it's too expensive. The other thing that's going on in people's heads is that they think they've missed out on buying it at an earlier point in time. That is irrelevant. It's irrelevant what you could have done last week or last month. It's irrelevant to what you're doing now. You're looking at the chart now. You have a chance to buy now. The other thing that people think is, oh, I'll wait for a retracement. And they think, oh, well, this is going up. I'm going to wait for it to go down, but to then go back up. Where is the logic in that thinking? Well, I personally don't think there's any logic in that thinking. Unless you use some really advanced techniques where you know that the bigger picture is up and you want to just maximize the move. But guess what? That is quite a tough thing to do, and it's much simpler just to buy when it's going up. And apparently someone did some statistics, I don't know where they got this from, but 97% of investors do not buy new highs. But most stocks that make huge gains do so after already making new highs. So think of all the stocks that we've looked at. They're all going up, and they're going up more, and they're going up more, and they're going up more. So every week there's a new high, or at least a new high in the last year. Some of them have got a new high since whenever they started the company, and they've never had. One of the great ones, actually, I wish I'd bought some a bit earlier, is AVGO, which is Broadcom. Let me pull it up on the screen. So let me pull up the...
You're too scared to buy it? It was too expensive, Marcus.
Well, I was out of the market for a while, and then... let's have a look at the US companies up. Shares US up. Right, where are we? Here we are. AVGO, Broadcom. Let's go over here and choose the 5-year chart. Look at this chart here.
Wow.
I mean, that's brilliant.
Wow.
Brilliant, brilliant, brilliant.
It's very hyperbolic, though. Or last little bit seems to...
Not, well, maybe. Actually, I wasn't even thinking of this. I was actually thinking of NVIDIA. Let me go to NVIDIA. So add share to portfolio, NVDA. NVDA is an even more impressive stock over the last 5 years. Look at this. So it's gone. It looks as if it's gone sideways, but if you zoom in, you've actually got. Say again.
Capped up.
It did gap up. It gapped up here. It's gapped up here. It's gapped up here. These are all the earnings. These are all the good earnings where the market. So we've gapped up here. Where's my ledger? Where's my pen? Can't see the pen, but it's gapped up here, gapped up here, gapped up here, gapped up again. So this is a brilliant investment. Yes, you would have been stopped out a few times on the way, but you would have still made a fortune just staying with this share and going back in when it got to the next high. So you would have stopped out here somewhere, buy back in here. You would have been probably okay for most of this. Up, 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 up. There's not that many 10% retracements here. Yeah, it's got a bit more moving around a bit here. You would have got in up here. Well, you know the system, so I don't need to tell you all that. So, I'm sure you won't do this because obviously the KISS method is buying at new highs in most cases. Mistake 4 is staying married to a trade. Loyalty and faithfulness are good for friends and family, not with individuals. So, just follow the KISS exit strategy. If it's going down more than 10% from the previous high, just get out, which your automatic order should do anyway. So it takes away some of the motion. Say again?
Well, if it continues to go down, then sort of consider if it's a KISS downwards thingamabob.
Yes.
Sure.
I mean, generally speaking, I'm not a fan of automatically switching into a short view because, as you know, a short view needs to be the opposite of the long view in all respects. So the market should be going down, the sector should be going down, the stock should be going down over a year at 3 weeks and 3 months, 3 months and 3 weeks. And you then buy below, sell short below the recent low. So just because the share price has suddenly started going down, it's highly, highly unlikely that all those other things have also changed all in a few weeks. In fact, it's impossible to have them all change in a few weeks because you're looking for a three month and a yearly downtrend, ideally for short stocks. Once you've got your 3 buckets up and running, there may be some that you want to take a bit more of a. They may not be qualifying on all areas, and you may want to do a short position in your medium risk and high risk pot. But for the starter pot, stick to I would suggest strongly sticking to the KISS shorting rules, and not just because it's an uptrending that's suddenly going the other way. Okay, mistake 5. buying low price shares, this is very, very common. When I say low, it doesn't necessarily mean cheap, but a lot of people think that somehow that they're getting a better deal when they're buying some shares at 5p than if they're buying at £5. Obviously 5p is cheaper than £5, of course it is, but you're investing on the basis of having a pot of, say, £10,000, and you're putting £1,000 in whatever share that you want to be screening and finding that meets your criteria. So, what's the difference in buying 10,000 shares at 10p, which makes £1,000, and buying 10 shares at £100 each, which makes £1,000, sorry. So you've invested £1,000 in both cases.
One covers the KISS approach and the other one doesn't.
Well, yes, that's true, absolutely, because it's not. Well, I've generally suggested buy UK shares above £1, but I've put here 75p. 75p would be my sort of absolute minimum. Above £1 is. It doesn't really matter, but certainly nothing in the 10p, 5p, 1p. Stay well away from those. I'll mention a couple other reasons in a minute. But the other thing is, if you're putting £1,000 into an investment, it doesn't really matter. I was actually teaching my son some of this on the train today, and he's very intelligent, but I was showing him the list of some of the stocks, and he looked at a couple of stocks. For example, Google, and Google is a very high price stock. So if we just pull up the Google price, so let's pull up Google in here. Hang on. GOG. Oh, I need to widen the search. Change list to, let's have a look at, I want US, and I want US shares, and then Google. So you can see, if I search all the US shares by the price, there's not that many that are in this high price here. So Google is the 8th most expensive share you can buy in America, $823 for one share. The prize goes to the Berkshire Hathaway, Warren Buffett's investment business, which is one share is $247,000. So my son said, "Oh, but surely it's better to buy a cheaper share than Google 823." But if I said to you, you could buy 10 shares at 82 as opposed to one at 820, but you put well, in this case, $820 in either, what is there any difference? If so, what's the difference in terms of the likelihood of your investment going up? Well, if they all meet the criteria, it doesn't make any difference at all. The whole point of investing is you're making a return on your capital. Whether you buy 10 tins of baked beans and baked beans are going up in value, or one big tin that's 10 times the size, it doesn't make any difference, does it? If baked beans as a whole are going up, whether you buy a 10-pack or a wholesale pack, it doesn't matter. So all you're doing here is you're buying a share in a company that happens to have one share priced at 823. If Google goes up 10%, how many dollars do you make? $82. If you buy 10 shares in another company, which is $82, and you spent $823 buying 10 shares, and that went up from $82 to 10% or higher, how many dollars have you made? You still made $82, whether you bought 10 times $82 or you bought one at 823. Does that make sense?
Yeah.
The only very small difference is that what happens is, in some cases, people can't afford the price of one share, so you're actually taking some potential share buyers out of the market. So I can tell you, for one, I don't have enough money at the moment to buy Berkshire Hathaway share. So next week I will do, because you guys are going to lend me some money. No, only kidding. But what I'm saying is that is beyond the ability for most shareholders to actually even buy one share, and you can't buy a part of a share. So some companies do what's called a stock split. Once the share goes to 100 or 200 or 300, that if it goes to 300, they might do what's called a 3-for-1 stock split. If you've already bought some, You will have a share certificate or an electronic share certificate saying you've got one share at 300 or however many you bought, and they will convert those 3 shares into 3 times 100 shares, so $100 shares. So your investment is exactly the same, but instead of you having 1 share valued at 300, you have 3 shares valued at 100. Your investment is exactly the same, but it allows people who only have 150 quid to buy 1 share, whereas if you only had $150, sorry, then they wouldn't have been able to buy the $300 share. So the idea is that it broadens the market for the average investor.
But it's also spread the risk, isn't it? If you have 5 different shares, is it lower than your share?
Yes, that's true. That's true. But whether you buy 1 share at 300 or you have 3 shares at 100, as long as you've got your portfolio spread across other shares, it doesn't make any difference to the diversification. The diversification is to do with the amount you've got invested, not the number of shares. Does that make sense?
Oh.
So if I've got £10,000,
yeah,
I don't want to put all of them in the same company. If I put 1,000 in the shares that were at $300, I could buy maybe 3 or 4 shares, but I won't want to put more than about 10% of my total pot in that 1 share company. If they do a stock split, it's not improving my diversification because I'm still limiting my 1,000 quid allocation to that company. Does that make sense? So them doing a stock split is not helping my diversification. I should have been diversified before they did the stock split anyway. Yeah?
Yeah.
Okay, so just a couple other reasons for not avoiding low price shares. When you start buying shares that are 1p or 5p, you'll find the bid-ask spread, the difference between the buying price and the selling price, is much bigger as a percentage. Okay? So when you're buying a share at 5p, the next unit up is 6p. So 1p, what's 1p as a percentage of 5p?
20%.
Well, you're already losing 20% just by buying the share. If you want to sell it the next day or next week, you've got to make 20% just to cover the difference between the buying and the selling price. So it's madness. Madness, madness, madness. The other thing is, for whatever reason, I don't really know why, it doesn't really matter, but the really cheap shares, in theory, it shouldn't make any difference, but for some reason, most sensible companies that have enough of buying and selling do not have a 1p or 3p share price. I don't know if there's any rational reason for it, but the lower price shares don't have much liquidity. So if you want to buy some on one day, you want to sell them the next week, you'll find there's not many buyers and sellers in the market. So I recommend that with all your investing, you want to stay with investments that are liquid, which means there's enough buyers and sellers there. It won't make much difference at the moment with 1,000 quid, but if you get your portfolio up to a bigger number, if you're buying and selling 10,000 or 50,000 on one day, you need to have somebody out on the other side who's willing to buy them off you, or the other way around. So liquidity is a problem with very cheap shares. The other issue is share ramping. Ramping is a jargon word which means that people will artificially put news out to make people think that this company is good and that the share price is going up. So what they'll be doing is there won't be that many shares. Every week they'll get some of their friends to buy some shares, make the share price go up, buy some more shares, make the share price go up, and then they'll sucker you in with these emails saying buy this, buy that, and the emails will have some elements of truth in it, but they'll be like 1p shares or 5p shares. And once enough idiots have bought based on emails rather than following a proper strategy, they've moved the share price up 100%, 200%, and then all the original people who were in on the scam at the beginning, they start selling all their shares because they bought them all, and then they started manipulating the news with the emails to silly beginner investors, and then they start selling all their shares. And then after a few weeks, the price suddenly dumps down because there's no more selling, there's no more buying pressure, and all the original guys, they've bought in at 1p, they've ramped the price up to £1, they all sell out at £1 or 90 pence, they make 900 or 9,000%, and all the other guys are losers. So the 5 guys at the beginning, they ramped it up. But they can only do that because there aren't that many shares available, and they've got enough money to move the share price up on the cheap shares. And any professional investor would not go anywhere near those type of shares. So, and the fourth reason is they're cheap for a reason. So, all good reasons to avoid any cheap shares. Cheap in the sense of lower end of the price. So in the US, I would stay above $10. In the UK, above £1 or above 75 pence. Okay. Mistake 6, over-diversifying. Some people get too excited, and I know some people I met at investing clubs, they have shares in 50 different companies. Say again?
Is it $10 in America? Because
I would suggest over 10. If you're trading options, which we'll do in the intermediate course for those who come on the intermediate course, I would have a minimum of 15 because I tend to stick to optional shares. I'd use 15, but for normal share trading above 10, I would suggest.
Okay.
It doesn't really make that much difference. You're well in the clear. If you see a really good share at $8, you could maybe bend that rule, but for simplistic reasons, just use 10 as a nice easy number to stay above. In the UK, above £1. Although there's some fairly good companies above 75 pence. So again, like I said before, none of this is a fixed science. It's just a suggestion of a level to stay above. So apart from the mistake of under-diversifying by only investing in 1 or 2 companies, obviously not good because you're not spreading your risk. Some people go a bit too far the other way, and they have like shares in, I don't know, 40 or 50 different companies. So why are you doing that? You cannot be following 50 companies sensibly. It's possible that what benefit is that? Generally speaking, in terms of the mathematics of diversification and risk reduction, which is, you don't need to study the maths, but I can tell you that above 15 shares, there will be no noticeable change in the mathematics of minimizing your risk. So after 15 different types of investments, there's no point in buying any others for the sake of diversifying. Okay? Which is why I generally suggest that you're going to be in approximately 10 shares or 10 commodities or a mix, but you could have 20 or 30 in your list because you don't know which of those are going to hit your buy point first. So you put maybe 15 orders or 20 orders on Interactive Brokers, and you let the market decide which are the first of the ones you put the 20 orders in for are the 10 that you're actually going to buy. So somewhere between 6 to 12 investments is a good ballpark. Yeah. Mistake 7, buying on tips and rumors. Oh, I seem to have the header slide missing. It doesn't matter. This is a true story that I was suggested to buy on a tip. A friend of mine was somehow involved in consulting for this company, Equator Exploration. Another lady I'd met who also knew him also had bought shares. She somehow did some of the PR for the company, etc., etc., etc. And they said to me, "Tip, buy this. There's going to be an announcement next week." I was already slightly cynical about tips at this point in time, but I kind of just listened and nodded, and I thought, okay. I thought, out of interest, because I don't follow tips, out of interest, I'm going to have a look at the chart. Now, what do you guys think about this chart?
Looks up, trend up, sideways.
Trend up over what time scale?
Over 05 to 10 months.
So we've got
Sideways for the last
15 months there. So, yeah, it's an annual, it's an uptrend, a year uptrend, it's a 3-month uptrend, and it's
sideways for 3 months.
It's sideways up. Yeah, I would say it qualifies as up, to be fair. 350 to 400 I think is good enough to be called an uptrend on 3 weeks. So, does it fit the KISS? We don't know about the good company bit, but does it fit the KISS strategy from a chart and a momentum point of view?
Yes.
The momentum's slowing down, but yeah, it does fit
Well,
into some.
yeah, but what you'll find, by the way, you'll find that over time, when shares go a bit up, you'll find that it looks as if they're doing more up-down moves. So can you see it's not too much? This looks like a bigger down move, and that looks like maybe more, but percentage-wise, it's not much different. So if you look at the difference percentage-wise in that move, 250 to
80,
180, that's maybe a 25% drop or 20%.
yeah.
This one here, from whatever that is, that's about 130 to 115. That's about 25% drop. But this, of course, looks much bigger because now that the price has gone up. But that's actually 25% here, and that's 25%, and up here. So anyway, so let's see what happened at the announcement.
Oh my goodness.
Unbelievable move. So I can't even remember exactly what the announcement was, but the announcement was here. And then the share price proceeded to do this in a period of 3 weeks. It is one of the most amazing share price drops I've seen in 8 years of trading.
Mm.
So it's a particularly interesting one because it does actually fit the KISS criteria on a chart basis. I don't remember doing the good company assessment, but for me, it showed a classic example of any insider or tip type trading is that anyone giving people tips, whether they mean to or not, may result in people buying the shares exactly at the time that all the insiders have decided to close out their position and want to sell. So you've got a lot of mugs who are buying just as you want to sell out most of your or all of your position. So people will deliberately put out tips to buy when actually what they want to be doing is they themselves and their friends want to be selling. So it may not be deliberate manipulation, but it is a type of manipulation in a way. It may be accidental. The company even put out an announcement saying they didn't know why the share price was going down. Well, guess what? You and I could tell them why the share price is going down. What's the simple reason for any share price going down?
People are selling.
Exactly. More sellers than buyers.
Almost said
Was there an obvious news announcement? I don't know. I don't think there was because I had a look. Anyway, so my suggestion is well, let me ask you the question. If you get a share tip, what would you do with it?
Just look at the chart.
Exactly. So the recommendation is, if you get a share tip, look at the chart. Does it fit your strategy? If yes, fine. If it's a good company, or it's at the very least, the chart is up, fine. If you'd bought this, and you not more than 10%, and you bought it above the high, let's just go back to the previous chart. So the high would have been buy above 400 and whatever that is, probably 405. So guess what? It never actually went. So you wouldn't ever have bought this following the KISS strategy after the day I got the tip, which was about a week before the announcement.
It's almost like whenever you get a tip, it's worth looking at the last lowest little low and putting a stop, a short on. It seems with all these air quote tips.
Maybe. But there's the simple. Remember what I said about shorting. It needs to qualify on all the shorting criteria to make it a really good.
It does, but if you've set a 3% trigger that if it goes back up again, the maximum you're going to lose is 3%, isn't it?
Fine. Yeah. Well, this is, I would say, for your medium and high risk pot. Once you've made money with the standard risk pot, then I would say be my guest and do some trades like that. Yes. So here, you could have shorted here and made an awful lot of money. And by the way, in the high risk, medium risk pot, you can also be a little bit more relaxed about the stop loss. You might decide you're happy to risk 15% instead of 10. I would generally stick with the 10 or the maximum of 12 anyway, because even if you stopped out here, you would have gone down here and then back up. You would have been stopped out. You would have made profit here. Then you would have another sell stop here, and then you would have made a profit here. Look, in 3 days, it dropped from 200 to 100. and then it went back up to whatever, and you would have been stopped out maybe here. So you would have had, within 2 weeks, you would have made 2 nice big chunks of money from the short side.
But you said short need to be need to qualify for the period, isn't it? For the
I'm just going through the example. If you had shorted this, it doesn't meet the KISS criteria for shorting.
no.
So I was just answering John's question. If you have a medium risk fund and a high risk fund, you can do some trades which don't meet quite so many criteria, because it does meet the it meets part of the criteria because it's breaking below the low. And I happen to know that this is quite a small company, didn't have that many shares. And I can see from, can you see that this bitty, the chart's a bit bitty? Can you see here? There's little clues that there's not enough liquidity. Can you see that's always sticking around the 350 here? Can you see there, 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 there? Can you see how there's this sticking around the 350? This doesn't really happen unless you have a share with not enough liquidity. And this sort of boxy shape like this, that's when there's not enough shares being traded. Yeah, so I would steer clear of these type of shares anyway, because I can see, from my experience in the market, I can see there's not enough liquidity. Okay, last mistake then. Obvious one, not following your investing plan. So you know, guys, you know how to do this. Have your strategy, have your plan, use a checklist, follow the golden rules, which I haven't listed as such as golden rules, but you know what they are, and keep a diary. Any questions on those mistakes?
No questions.
Good. Okay, let's go into the Q&A part of the webinar then. So, home studies. So, let's have some review of any 3 trades that you've done. So, let's start with Denise. Do you want to talk us through one trade that you've done?
I couldn't done today. When I send you guys a screenshot. I don't know what's going on with my interactive broker. I can't place order. I can't find places to choose which share it is or something like that. I was confused.
Okay, well let me jump to I'll jump to section 3 in a minute. But John, do you have one share? If I give you the control of the screen that you might want to share.
Yeah, I can show you one I bought, and also a reason why another one didn't buy would be quite interesting.
So let me make you a presenter.
Okay.
So you should then have control of your screen, and we should, once you click the button on your screen, we should be able to see it. You may need to move it to the other screen depending on what the active screen is if you've got 2. Jolly good. So we can see the orange sunset. Okay, so talk us through this one.
It's the name of the share.
Do we have sound? Let's check that. Oh, sorry, John. It automatically put you on mute accidentally. You should be able to speak now.
I'm unmuted now. So this is a trade that I put on about a week ago, TRI, and I don't know what's going on at the moment, but it looks like it's still going. There's a trail there, trail sell. Can you see my screen?
Yes.
So it looks like it's still going up. Seems to be doing all right. Now, for some reason, I tried to place this Glen order, and I don't know what's gone on. I don't think it's bought yet. Here we go. It's not tripped the buy thing yet. So I've set the limit at 335, and it's not hit it yet.
Yeah. By the way, Denise, just for your information and anyone else watching after the recording, Interactive Brokers has got this really nice feature that it shows the lines of where you put the buy stop and the sell stop. A bit like in ShareScope, we have the share stop line, but the ShareScope doesn't have the buy stop. So it's quite nice to see where the green is where you're going to enter the trade, and red is where you're going to exit.
Yeah.
And
So that's
the red will obviously,
so,
that red one, the red line will move up. It doesn't have quite the same design as ShareScope, so you don't see the steps in the red line. It's always just a straight one, but the line will actually move up automatically.
yeah. So it will. I assume it just follows that up and just carries on moving up. But obviously, what it doesn't, what I couldn't seem to find, and maybe it's on here somewhere, and you can explain it to me, Marcus, is when did I actually buy this? Does it date? How do I find out when I bought it so that I can put a little kind of mark on it somewhere and sort of draw a line, or go back to ShareScope and actually say, oh, look, I got in at this point.
That's a very good point.
I haven't put a sheet into TRI, but I know I've bought it because it's in and it's trailing. But it doesn't. Yeah. What it doesn't have here is anything. I couldn't see in details on anything of or the summary when it actually bought it.
Yep. No, I'll cover that in a moment. So good question. So, but just going back to the bigger picture. So I presume you found this by what method did you find these two shares, the TRI and the Glen?
I think TRI I used with the ShareScope. That was the first sort of.
So good companies then trending up, presumably. Obviously, it's trending up because I can see that.
That's over last year, so that's going up. Yeah, so I decided on those two, but I haven't done any more.
Very good. That's excellent stuff. Okay, so what I'll do now then, I'll answer those questions and also just clarify for Denise how to place trade on IB. So if you'd like to return control.
I think you can grab it back, can't you?
Can I show my screen?
Yes, you can. Let me make Denise presenter.
I have a few questions.
Okay, Denise is now the presenter. If she clicks on her screen.
Hold on. Okay.
I have to wind it up in a minute, Marcus.
Okay, fine.
But I should
do another 5 minutes.
I'll definitely watch the webinar from whatever you do with Denise.
Well, I think we've done a good session anyway, so we'll keep some of the other things for the next webinar because we'll get all 4 people on next Sunday. So Denise, are you okay to share your screen?
Hello, can you hear me?
Yes, I can hear you, but we can't see your screen yet.
Just give me 1 second. I just tried because on my screen and my share is on the computer, but I'm talking the GoWebinar is on iPad, so I'm connected with the computer.
All right, yeah, you need to be on the GoToWebinar as an attendee on the same computer that you're sharing the screen from, obviously, yeah.
Maybe you could use it with your webcam and from your laptop and your screen.
You would have to, if you're on a different computer, you'd have to log into the webinar as another attendee.
Looks
like
you able to show us the answers to those questions on your screen? Because it doesn't look like we're going to see.
I'm now making you presenter on the second login because you're logged in twice, which you can do on GoToWebinar. So I've now made you presenter.
Share my screen. Okay, I'm sharing. Hello, you mute me.
Okay, we can see your screen now. That's all good.
You can share my screen. Okay.
Yep,
you see? Can you see my screen?
Yeah, you need to click on the. Yes, I can. Yes, we can see it. Oh, excellent. Jolly good. Yeah, you need to click on the. Yes, I can. Yes, we can see it. Oh, excellent. Jolly good. Oh, I've got feedback from you now, so you need to mute your.
We're hearing Marcus twice. That's terrible.
Mute your.
We're hearing Marcus twice.
Okay, hello?
Okay, that sounds good. So,
You see, I can't place order here. I'm a bit
right.
confused. Where can I put, you see?
Right, first thing you need to do is you can't place an order without choosing a buy and sell. So choose a buy and sell first.
Yeah,
So you need to, on the left, you need to choose a buy. That's it. So how
yeah.
many do you want to buy?
That's
Click
the
on the
20.
20, okay. And the stop level is what?
Stop level is, stop level is, I guess. I'm a bit confused. 5-7. Is it here?
That's right. So type in the stop level. Presumably it's around about 122 or something.
The share price is it's here. This is price, isn't it? 579. So 10% up to 6323.
But the buy stop, what's the key strategy for when you buy above the recent high? How much above the recent high for buying?
Oh, okay. I tell you what, because yes, I didn't.
So it's 1%. The buy entry is 1% above the previous high. The buy entry is 1% above the previous high.
1%. Sorry,
The buy entry is 1% above the previous high. The sell stop is 10% below the high. Buy is 1% above.
Oh, 558. So in that case, it should be 5856. Is it right?
Hi, Denise. Hi, Marcus. I'm gonna hang up now, but I'm gonna watch the video talking about on the recording.
Yep. Okay. Cool.
Okay.
There you go.
Thanks.
Really good. All right. Thanks, Marcus. Cheers, Denise.
Yep.
Bye.
Bye.
So, so the buy price is always 1% above the previous high. So that calculation was correct. The only thing is, on your spreadsheet, you've chosen a different share than what you've chosen on the left here. So which share is it you want to be buying? Is it APOG?
APOG.
Or is it VC? Because you've got
APOG.
Okay, so on the left-hand side of the screen, you've got a different share selected.
What do you mean? I'm confused. I don't know where to choose.
Well, on order entry, you see that white box?
Yeah, is it here?
That's the stock that you want to be buying.
So I need to put things like this, yeah?
Or if you're on the list above, if it's in your list at the top left, then you can just click on it and it will automatically put it in. So if you click on any of the shares top left, then
Top left.
Yeah, move up a bit.
You mean this one?
Click on any of those rows and continue. Right, can you see order entry has changed the symbol?
Yeah.
So if you had ABGO in that list, you just need to click on it and it will put the symbol in automatically. Or if you want to add it onto that list, right-click and insert row. Yeah, up a bit. Right-click. That's it. And now put the symbol AV, isn't it?
I think it's APOG. APOG.
Right.
This one.
Right, okay.
I already found it. Why it's too late?
I get this sometimes. You need to click on the one at the bottom, near
Yeah.
down a bit. Yeah, there. I find it a bit confusing, but that's the way they do it. Okay, so if you click on APOG, notice on the order entry, it's automatically put the symbol in. Right, now, so now we do the buy.
Yeah.
First thing you need to do is tell Interactive Brokers, are you buying or selling? And then the 1% above. Yeah, that's it.
And that's it.
Yep, and then submit. Check the just read that it's in line with what you want. Buy 20, order type, amount 1,100. That's approximately $1,000 or 10% of your account if you're imagining it having 10,000 in it. So that all looks fine at the moment. If you only want to put the buy in. But what have we not got yet? We haven't got the second part of the order, which is the
Sale, 10%.
Yeah,
10%.
we want to cancel that and make sure we add the trailing sell stop safety belt.
Yeah.
So there's a plus sign which is hiding behind that button. Can you widen that window a bit?
Which window? That's
Up a bit. Yeah, that you need to widen the order entry window. No, up. That window. You need to widen it a bit.
widen.
Yeah, is it? You need. Oh, can you unlock the layout? Top right, the golden padlock. Can you click on the golden padlock?
Padlock. This one. Golden.
Up and left.
Up left. This
Up
one.
right. No, that's not a padlock. Up and left a bit.
Left.
Up. That's it. Yep. Okay. So close that small window in the middle.
Which one?
You need to close the small window in the middle of the screen. Right, now you can widen order entry. Not that one, the one below. You want to widen it. Widen. That's it. Yeah, that's it. So now the plus symbol. Can you see that plus sign is now showing?
Yeah.
Okay, so now we click on the plus. You can tidy up the windows later. So attach stop loss. Click on the stop loss box. And now you click on the stop box and put trail.
Where's percentage?
Yep. Click on that second box and there should be a percentage. It's not showing at the moment, but click on the box anyway. No, not that one, the one before. No, the one in the middle. Yep, percent. It's a bit hidden for some reason, I don't know why, but... And then 10 in front. Oh, it's still amount. You need to check, make sure it's percent. That's it. Right, now, check margin, which is also the same as preview. Check margin also does a preview for you, so click check margin. It will probably come up with that message. Trailing stop orders can be attached to limit or stop limit orders only. I've got a support call open with IB. For now, we're going to change this to a stop limit order. So if you click OK, go back to the original order, the buy order, up a bit, and click on the middle box where it says stop.
Where's the stop?
No, where it says STP in the middle of that window.
I can't see it. Where's stop?
Yeah, STP, above your mouse. Up. Click on the 58, that's it. Click there. Oh, sorry. Click on the box to the left where it says STP. And then you want a stop limit. So click on that grey arrow at the bottom. Yep, and find stop limit. STP LMT. Now you've got it already.
Why?
Right, now what this is, it is exactly what we want, but it's got something extra which we don't need, but we're going to do it anyway. So you're going to buy at 58.06, but you're now going to add $5 or $10 on top. Let's call $10 or $20 on top. So just add $20. Basically,
Why that? Because close to the 59?
It doesn't matter because we're going to buy any price above 50.8.06.
Yeah.
What this is doing, it's saying, well, don't buy if it goes too high, but we still want to buy it. So that's why I don't want to stop myself getting into the trade. So make it like 78 or 80. Put $80.
So buy above $80.
It needs to be in the limit box. You've got it in the stop box.
You mean?
The first box needs to be exactly what it was before. First box was 58.
50.
Yeah. And the next box needs to be a long way away, so it doesn't stop you buying it. So put 80. That's it.
What does it mean? Until.
It means that what this actually means is buy at 58, but not if the price. Trigger it if the price is above 58.06, but don't buy it if the price has gone so far that above 80. Supposing it gaps open, in theory it could gap open $10 or $5 because of good profit, but I still want to buy the share. And the limit order would normally stop you buying it, and that's why we don't really want to have the limit price anywhere near the current price, but we're having to use this type of order because the IB is stopping us putting the trailing on. So we're using a box we don't really want to use, so we're just putting it a long way away because we don't ever want to be limited on buying the share. So click on the plus again. So click on plus and just check the other bit of the order. That's fine. Click on check margin. Right. Order stop limit. We don't need the limit bit, but it's what we want is the stop. 58.06. Sell stop. Can you just scroll so we can read the rest of it? Yeah, that's it. 10%, that's fine. That's all good. So override and transmit. You've got a yellow warning about stop types. We know what stop types are, so you've read it. Fine. Override and transmit.
Which one?
At the bottom, override and transmit. And there's another stop order because you're buying a buy stop and a sell stop, so it comes up with the same message again.
10%.
Override and transmit. Yeah, override and transmit. Order sell will automatically be cancelled at the 30th of June, so it gives you at the end of the second quarter, which is fine. That's months and months and months away.
Oh, okay.
Okay to that message? Okay. Click OK. And because this is Sunday, this order will obviously become active on Monday when the market's open. So that's fine. OK to that message. And you should now have an order under the Orders tab. If you click under Orders tab, down a bit, in the Orders, you can now see your order is live. So there it is. APOG, SDP will buy at. Actually, for some reason it says stop 80. It should be 58.06.
You said here's, huh?
So
Can I amend the order?
yeah, you can amend it. You click on that row, click on the buy row, and then no, down a bit on the orders, down. Click on that, right click there, and just
It's
see.
here.
You've got the two prices the way around somehow or other. We want the stop price at 58.06 and the limit price at 80.
This price is for
80.
buy, isn't it? 58 is to buy.
That's fine. So we want to buy after 58.06, but we don't really want to be limiting ourselves, so we put the limit a long way away. So transmit, accept or transmit.
What does it mean transmit?
It means sends the order to the interactive broker computer. That's it.
Okay.
That's good. That's what we want. So you now have a live order to buy APOG if it breaks above 58.06, and if it does buy, you will have an automatic trading sell stop at 10% below. Well done.
Okay.
Good.
Can I Can I ask a question?
Yeah, just a quick question because I want to wind up the webinar now.
Yeah. I'm kind of lost. This is my keys. This is the shares I choose, yeah.
Okay.
And when I try to do this, because it's 39, I have to from this 39 to choose what shares. So I want to do data mining. When I do the data mining, it's like this.
You want to do what money?
Data mining.
Sorry, what money?
This one.
Data mining.
Yeah. I have this portfolio. You see on the top, turnover, blah blah, all this criteria. But on this criteria, I didn't really have time. I didn't really have place to put, say, 5% or whatever. So I want to do like among this 39 to do a short list using the data mining.
Okay, click on data mining and then top right. Oh, that's strange. No data.
You see when I choose sector F12 is a portfolio. If I do, you see the data here.
Hang on, let me just check. Are these American or English shares?
They are both mixed for some reason. I don't know why.
Most of these are US shares because the dollar.
Yeah.
Fine. If you go to data mining, go to data mining again.
This one, right?
Yeah. If you see top right, you've got LSE shares selected, and you've got SS Warren Buffett. So you need to change that list to your portfolio list.
How can I do it?
Yeah, scroll down. Your portfolio listed down there or not?
I can't see it.
Well, just put shares. Use the second one, shares. That's it. And then select the filter. Oh, you see, select filter. You haven't run data mining yet. So you now need to choose the filter that you want. And there's going to be one of the bottom ones. Is it KISS 1? Whatever you named the filter when you first did it. There you go.
Are they the shares? They are not the shares. The same share.
Hang on, this is the.
This is.
Oh, I know why. This is from all shares.
Yes.
So let's just see if we can filter on the portfolio. I think you can't filter on the portfolio after you've created the portfolio. Have a look at that other where it says other US shares. Just see if you can get the. Just see if your portfolio is listed. Is any of your portfolios listed at the bottom of that list?
Not at the bottom.
And okay, so it looks like the portfolio only works on lists. Sorry, the data mining only works on lists and not on an existing portfolio. Okay,
yeah.
So I'll have a look into that, but that explains that bit anyway. Does that make sense? We now know why the list wasn't coming up.
Okay. Another question I have is like from last week to this week. Obviously, in my portfolio, I changed some, this criteria like country, reach or whatever. I corrected. Then they create a different list. So I can show you. This is today the list I did.
Right.
Yeah. This is the last week. It's different, in a way. Yeah. Some shares change. But then I noticed
there'll be a small change because some companies might get added into the list and some companies might fall out of the list. But there shouldn't be a very big change from 1 week. Maybe 1 or 2 companies, maybe.
So I don't need to check the sector anymore, right?
No, once you've done, pick the sector once a month. Sector once a month is enough.
Okay. And then it's like I noticed most of my shares are American ones.
Right.
However, I'm not confident to see, like this U.S. sectors.
Unfortunately, the share
You
scope
do,
doesn't
yeah,
have such nice sector charts for the US. So
yeah.
the only way to get around that is by looking at 5 or 10 or 15 or 20 shares in that sector in America, and you just get a feel in your head which ones are doing well.
Okay.
Or you can choose the ones on the left there that are nothing to do with Nordic, but the others. But unfortunately, they aren't really what you want there. So unfortunately, that there's not such a nice sector chart in Telescope for the US.
Okay.
Okay, is that good?
It is good. Okay.
And I would separate your US and UK shares because one of them data mining should be above 75 pence and the other one should be above $10.
Okay. How
I
can
would
I separate? I'm confused.
you want
Or
to
maybe
split
do one US, one.
Go back to data mining. When you do the data mining, you need to select the list top right. Go to data mining.
Yeah.
And the list top right, you need to, for one of the filters, like now,
US shares.
US shares, and you need to save this data mining as KISS1 US. So if you go up to the file menu in the data mining menu, you can save this as the file save.
Here.
Yeah, and then also under data mining menu,
Data mining menu.
top left, the full menu, the top left one.
You mean here?
Yeah, right a bit. The fourth one. Yeah, and there you can rename the filter or copy the filter.
What's that? Where is it?
Well, they call it filter, but it's the screening, it's the mining. So if you want to copy this mining or rename it, you can do it by renaming or copying.
Rename it.
Yeah, so you want to rename that to KISS1 US shares. Okay. And okay. And then after this, you copy it and set.
So I just choose whatever shares I want.
Well, you're
and
missing
do another one.
you're missing one criteria, which is the price criteria. You've got five criteria. You should have, oh, there it is. Okay, so there you want 10 or, yes, so in cents it's 1,000.
Yeah.
So now what you do is you copy this whole filter and data mining copy, and then you do a UK version.
Yeah.
But with the UK version, at top right, you need to choose FTSE 350 or FTSE All Share.
Okay. So it's basically two different lists.
So,
yeah.
Because everything's going to be the same, except it's going to be 75 pence instead of $10.
Okay.
And the list. Okay.
Yes. Yes.
I'll let you have a go with that. Okay.
Okay.
Great.
Cool.
I will wind up the webinar. Thanks everybody for joining us this week, and see you again next Sunday. Okay.
Thank you, Michael.
Bye then.
I can get out.